I asked AI, has the stock market bottomed? Here's what it told me. It's impossible to predict with certainty that the stock market bottom is in, but there are several indicators including technical, fundamental, sentiment, and market data, which happened previously near major market bottoms. In this video, I will share with you 5 main indicators which happened previously near the major market bottoms, and we will identify if the market bottom is in or there are more downside to go. The first indicator is volatility spike. The volatility is measured by special index called VIX. When VIX is spiking higher, the volatility is increasing, which is pointing to fear in the market. In this chart, you can see S&P 500 on the top and VIX on the bottom. If you can see, right now we are at level of 30, and previously we have a market bottom in April 2025 when VIX spiked significantly higher than 30, and also bear market bottom in 2022. We also have VIX spiking to 30. But on the other hand, we can also see that here, and here, VIX was also 30, but this was not the bottom. So there is no indicator pointing for 100% certainty. But we can say that VIX and volatility spike is one of the indicator which could be showing the market bottom. For the first indicator, volatility spike, we make a check that this indicator is fulfilling the condition of potential market bottom. Let's go to the second one. The second indicator called market breadth capitulation. Market breadth capitulation is showing the percentage of the companies trading under 200 days moving average. Currently, 48.8% of stocks are trading below 200 days moving average. Usually, if 70 to 90% of stocks trading below their 200 days moving average, this means the selling is broad and exhausted. Almost everyone who wants to sell already sold. Historical pattern happens near the bottoms of 2009, 2020 and 2022 bear markets. So for us, we have 48% of the companies trading below 200 days moving average. This is not an indicator of bottom yet. Let's move to the next indicator. The next one is called put to call ratio surge. This indicator measures how much investors are buying protection. If put to call ratio is more than 1, it means a lot of investors are buying protection, which means they are hedging for potential more downside to go. And usually this is when the market is bottoming and ripping higher. Currently we see put to call ratio are 0.9, and if you can see in April 2025, this is exactly when we hit 1, and this was the bottom. Current value is 0.9, this is very close to 1, but not just there yet. Based on a third indicator, the bottom is not in just yet. Let's move to the fourth one, extreme negative sentiment. The sentiment is measured by American Association of Individual Investors. If you can see in March 18, we are north of 52, and recently in March 25, it's still the value is close to 50. So 50% of investors are bearish on the market for the next 6 months. So the sentiment is extremely bearish. That's why the fourth indicator of market bottom is showing that bottom could be in. Let's move to the fifth one. The fifth one is valuation compression. This is the fundamental indicator showing if the stock market is trading too cheap to ignore. And then if it becomes fundamentally cheap to ignore, investors just coming and buying the dip. Short sellers will close their shorts and the stock market will rip higher. Let's see what is happening with valuation for S&P 500. From the valuation perspective, the blue line is S&P 500 forward price to earnings ratio. Currently we are at a value of 20. I would not say that 20 is the dirt cheap for S&P 500. But on the other hand, we have to point out that this graph is starting from 1985, and on 1985 the margins were significantly lower than it is today. So if we are considering closer, for example, last 10 years, then 20 would be actually the average. But if we are considering more historical data, then I would say 18 or even 16 could be the average. So based on the forward price to earnings, I would say we are close to cheap, but not yet dirt cheap. And the forward price to earnings is already considering the estimation for the next financial year EPS, earnings per share. And when we're talking about valuation, we have to consider the growth as well. So here we can have a look at PEG ratio. PEG ratio is price to earnings growth ratio. This is the valuation metric that is calculated by price to earnings divided by annual EPS growth. So in this case, we can see that S&P 500 PEG ratio, which is this red line, solid red line, currently is very close to 1. And based on the Peter Lynch, if the PEG ratio is less than 1, the company is cheap. And if this is a fundamentally strong company, if this is a strong mode company, you should buy the dip. Of course, S&P 500 is not individual company, is a bunch of stocks, 500 biggest, largest American corporations, but we can see that usually when the red line comes to the 1, usually it's a bottom. We can see in 2012 this is the case. We can see in 2019 this is the case, in 2022 this is the case, and now we are coming to 1 again. So I would say the valuation is already quite cheap, especially for some sectors. For example, some sectors are already looking very cheap. For example, information technology sector, where I'm mostly invested in because I have a lot of expertise in this sector. So some of the sector of S&P 500 are already too cheap to ignore, but based on the overall for S&P 500 valuation, I would not say that this is close to bottom valuation. So for the fifth indicator we put no as well, and currently we have 3 no and 2 yes. If you want to know my opinion, I believe that the market bottom already happened, or we are very close to the market bottom. I'm already aggressively buying stocks where I finished my fundamental analysis, and on the channel you can find many videos of the fundamentally undervalued stocks which I was aggressively buying on the dip. Of course, this video is for entertainment purposes only, and this is not recommendation to buy or sell any stocks. I hope you enjoyed the video. Thank you so much for watching, and I'll see you in the next one.